everybody. Okay, the clock is ticking. I think we are cutting short a lot of the panel session because we're running out of time. So without further ado, I am going to just quickly introduce myself, talk a little bit about the panel, and introduce and have the rest of the panelists introduce themselves. My name is Sharon Ang. I'm based in Singapore, and I'm representing Cboe Global Markets, which is the biggest U.S. options exchange in covering global derivatives sales for the company. And we are thrilled to be here today and to see all of you here today to speak about a topic that is very relevant for the markets these days. But I think you have also probably heard the word resilience a zillion times today. So the topic, how do we build resilient portfolios and make it work in an era of uncertainties? So now without further ado, we have brought together a very esteemed group of panelists with very diverse experience and also different perspectives to bring these topics alive. And so let's dive right in, and to kick this off, I will hand it over to the panelists to give a quick introduction of themselves. Keith, you want to go first?
Sure. Thanks, Sharon. Hello, I'm Keith, and I'm from SocGen, and I looked after listed products distribution in Asia, and I'm based in Hong Kong, but we have listed products, leverage inverse products that are listed on the SGX, the Singapore Stock Exchange. So look forward to sharing with all of you fellow panelists as well. Thank you.
Hi, my name is Janjira. I am the head of intermediaries for Southeast Asia at State Street Investment Management. Very glad to be here today, and our company managed 4.6 trillion in assets, helping the institutional clients with their investment portfolios and so on. So yeah, look forward to this discussion as well.
Hi, my name is Christian. I'm an investment specialist, part of the US equity team at JP Morgan Asset Management. So we manage multiple strategy, US equity related, and always a big topic, what's going on in the US. So I'm glad to be here and speak about this in front of a big audience.
Oh, okay. Good afternoon, everyone. My name is Bertram. I'm with Nikko Asset Management. I'm with the Asian Fixed Income team. So within Singapore, we do manage the two Singapore dollar bond ETFs, a government ETF and a corporate bond ETF, and also we manage another China bond ETF. So we manage Asian fixed income out of Singapore, and looking forward to discussing with the panelists.
Thank you, everybody. Okay, so I'm sure you have been, absorbing a lot of information today. So we'll keep this discussion very light. We'll unpack what we mean by building resilient portfolios. So why do we say that this is very relevant in today's world? Well, we have been facing a lot of market volatility, I think, in the last 6 months alone. You would be familiar with, what we're reading in the news about geopolitical tensions, tariff tweaks, trade wars, and so on and so forth. So we have seen also in the last 6 months, the volatility index VIX peak at more than 50, and then now back to the more normal levels of 16. So what does all of this mean? So we will, just to give you an idea of how we're going to be running through this discussion today, we will first touch on some of the macro landscape, what are the key themes that is prevailing in the market today, before going into what are some of the factors that what are the biggest risks, what are some of the issues or factors that we need to pay attention attention to how to protect your portfolio from volatility before going into like what is of interest, like where are the highlights going into the second half of this year. Very timely as well, given that we are just going into July. So without further ado, let's set the macro outlook. I'm going to ask Christine this question. So how would you characterize some of the key themes, some of the key macro themes in the current economy?
Yeah, sure. So I will say a few things, like specific to the US, like when we think about the economy, what do we expect over the next, say, couple of quarters is an economy which is still growing at this point in time, but, which is moving to a slower growth, like type of like environment. And when you think about like, policy uncertainty, trade policy, you think about the impact of tariffs, like we do think over the next few quarters, we might see GDP growth in the US to be below trend. If you look over the last 10 years or so, GDP growth in the US, like trend has been about 2%. So when we say below trend, we think, maybe GDP growth will be slowing down somewhere in the range of like 0.5 to 1% temporary. And that means the economy is still growing, it's just growing at a much slower pace. So I think, many people still think about the potential of a recession. I would say it's more of like a slowdown at this point in time, what we expect, rather than having a recession in the US. At the same time, you have like, one of the other, impact of tariffs being like inflation. Inflation made a long way from like, being extremely high, like if you go back 2 years ago, to now being closer to targets. But we need to think about potentially we might see inflation once again, temporary increase, somewhere in between like 3 to 4% to then slow down again and go towards like that 2.5, 2% over into the next year probably. So it's likely still a period where we're going to see volatility because of this slowdown we're going to see over the next few quarters, but I think it's not a extremely bad environment characterized by recession.
Thank you, Christian. I'm just going to ask Janjira to kind of provide some additional context. Do you think we are headed for a soft landing, or do you think there are some dynamics that are still changing?
Yeah, I think in general, we feel that the US economy is still holding up quite strong, better than expected, but definitely the dynamics have shifted. So when we look at the recent data, it has given us the mixed picture. Like on one hand, you do see a strong labor market, consumer spending, and just a few days ago, you saw the headline about S&P 500 hit the all-time high. So it's quite positive for the market or investment perspective. However, on the flip side, some of economic data started to be concerning for the investors. Like, for example, non-farm payroll, it looks quite positive in June, 147,000 jobs creation. But if we drill down into that numbers, basically it's primarily coming from public sector. So private sectors is actually struggling, and we do see that it hit the lowest since October 2024. At the same time, credit delinquencies, hit the highest since 2011. So this shows the financial stress within the low-income households and small businesses. But again, in order to smoothen this out, I think Fed will have to take a look at the interest rates to help with the businesses so that the borrowing rate will become lower. And we do see that potentially, the interest rate should come down, and if we can have 3 rate cuts this year, that could potentially help to smoothen the process as well. So I think in short, soft landing is the base case for us, but it's kind of getting bumpier. So we have to monitor all these economic data very, very closely and see how fast that Fed can react to that situation.
Thank you. And so Keith, so what do you think, since we're on the macro themes, what do you think are the biggest macro risk that investors would be facing as we moved into second half?
Sure. I think, if you look at the US trade policy and all the tariff, it's still a very fluid situation. So I think moving towards second half, we should get a bit more clarity on, what are the tariff, what kind of rates Trump is going to imply into different countries. If you look at the first half of this year, right, if you just look at the stock market, I mean, since the Liberation Day, all the equities are already back up to the pre-Liberation Day levels, with high tariffs that are probably impacting growth, global trades. There's talks about inflation, high interest rates, but the market seems to doesn't care much. You see the S&P is trading at record levels, right? So as tariffs becomes, I guess, more clear, I think investors will start looking at the real impact to the economy and especially to the earnings, where how corporates are going to deliver their reports, how the impact's going to come out. So I think the important point is still a lot of uncertainty that will create a lot of volatility in the markets. And so later on, we can talk a bit more about how we should manage these kind of risks.
Yes, indeed. So investors seem to be shrugging off all the troubles that we think are brewing. So since we're still on the U.S. theme, I'm going to ask Bertrand to perhaps give us his view on the U.S. dollar. Like, it has been weakening. So what are your views and thoughts about where it's going?
Sure. For us, we view from an Asian fixed income space, and the de-dollarization theme is playing out. This year, Asian fixed income and Asian dollar, Asian currencies has been performing well. And so there's a lot of reallocation outside of US dollar. And we see that in Singapore. And the Singapore dollar has been performing well this year. If you look at the 10-year US Treasury rates, it's been around 4.4, but for Singapore dollar 10-year, from around 3.3 last year, it's been going down to around 2.2. So you can see that it's sort of like an asset allocation going into other high quality, other kind of safe haven assets. And we see that ongoing in terms of global reserve managers. They've been reducing their US dollar allocation. It's now below around, for central banks in terms of reserve management, their US dollar allocation is now like 58%. Like 10 years ago, it's probably 60 to 70%. So we're still seeing increasing reallocation. It's not going to be off the US dollar in terms of dominance. It's still going to be a dominant currency. It's still the largest economy, most liquid. But I think it's going to be more diversified in terms of currency allocation. There's been more allocation for reserves into Euro, into Japan, and even into Singapore, given how we're still a AAA country with strong fundamentals.
Thank you. So, Bertram, since you mentioned this flight to safety play, so let me ask you this question. Do you think traditional safe haven assets like gold and bonds, do you think they are still reliable defensive plays? Or do you think investors should be also expanding their search elsewhere?
I think gold, bonds, they're still playing their role. They're lower volatility asset class. They perform, especially for high quality AAA kind of countries, they play well during risk off environments. And we see that in the performance of a lot of these AAA fixed income instruments. And we see that in how gold has performed this year. I think there's still a good diversification tool, good for risk off sentiment plays. And so there's still traditional safe haven assets. Of course, there are other new safe haven assets, maybe Bitcoin for diversification or other assets, but traditional safe haven asset classes like bonds and golds will come into play still.
Right, Janjira, any thoughts on that?
Yeah, I do agree. And basically, bonds have been part of the defensive role for a long time. But we actually see that in the times of high inflation or the aggressive rate hikes, actually the power of defensive qualities of bond can be weakened quite a fair bit. So sometimes the investors have to be more selective, then have to focus more on like duration, credit quality, currency exposure. On the other hand, gold, as all of us know, that has been the best performing asset class. And basically, I think a lot of people ask me the question, right, since we have seen gold price has been rallying for a while now, is it the highest already? In our point of view, we have seen a lot of factors that will support the gold price to continue. So a few things that I can highlight today is that, like we have seen the shift, that policy from the government, for example, China has allowed the insurance company to allocate 1% of their portfolio to gold now. And that can be quite massive if you think about the size of the portfolio that the insurance companies manage is billions of dollars, and by allocating just 1%, right, that can potentially push the gold price up. At the same time, and this is the most important factors, is that the central banks buy. We have seen a strong support from central banks, and most recently, World Gold Council sent the survey to the central banks, and 73% of that responded that they're going to reduce the US dollar reserve. And what it means is this could be beneficial to gold as well. So this has been acting as a defensive asset for the investors. And I feel that this will continue to play out as both the capital gain as well as the defensive as part of gold.
Thank you. So you can see that we are now kind of moving into defensive positioning. So Keith, what are some effective asset allocation shifts that investor can potentially make to reduce downside risk or protect or hedge against potential volatility?
Sure. So, obviously, everyone has some sort of a holding in the US market, I assume, especially these Max 7 stocks. Investors, as these stocks are going into record high levels, you're kind of thinking that, okay, how should I hedge against any short-term downside risk of these stocks? And some of these leverage inverse instruments are some choices you can look at. So we have these leverage inverse products listed on the SGX. So obviously, if you're looking to short-term hedge some of your US stock positions, we've got these inverse products that you can look at. And we also noticed that since first half of this year, besides US stock market, I think a lot of investors' interests are also shifting towards Chinese equities, Chinese tech stocks. So, in order to get an exposure to these stocks, obviously you can get into the share itself, but there are also other instruments that gives you a small leverage listed on the SGX that tracks Hong Kong underlines as well. So, in terms of diversifying your portfolio, besides the use of stocks, you can also have a look at these instruments to help you be more efficient in your capital allocations.
Right, okay. So with all these diversification going on, from US stocks to Chinese stocks, Christian, just like your views, so how should investor be thinking about diversification when different asset classes are growing from a correlation perspective?
Yeah, I would say, first of all, like historically, what investors have been doing is trying to hedge some risk on the equity side with typically bonds in a kind of a 60-40 type of portfolio. And I think if you look back at the last 10 years there, you do see that at times of market volatility, bonds, they've not always been active as an uncorrelated or negatively correlated asset class to equities, which meant stocks were going down at the point in time where actually bonds were also somewhat going down. Prime example of that was 2022 when the S&P ended the year down close to 20%. US bonds were also down. So that traditional 60-40 would have been down quite a bit as well. From our standpoint, from an equity perspective, we think there is a better way to hedge the downside risk, which is not assuming those correlations will hold over time, which is to make use of options, in this case index options, on top of an equity portfolio to systematically hedge on the downside. And the reason for that is that, let's say if you have an S&P 500 type of underlying portfolio and you're using S&P 500 options to hedge the downside, you don't have that risk which you have in terms of the correlation turning from negative to positive between equities and bonds. So that means when the S&P goes down, you are having an effective hedge, which works when it needs to work. So I think option and index options in particular can play a big role in hedging US equity portfolios. The other way to think about is utilizing options for income generation. So you own an underlying US equity portfolio, you're selling index options on top of that to generate income, and that income generation acts as a buffer on the downside during periods of market volatility. So I think, again, options can be used in a few different ways here, like to protect on the downside systematically, if you're buying protection, or to generate income, which act as a buffer on the downside. And typically when you see a sell-off in the market, that happens with higher volatility. You referenced the VIX going at 50 earlier this year, and that means higher income generation as well. So these are just some ideas, how can we think about diversifying and protecting on the downside, which is not relying on historical correlation among asset classes.
I think that also explains. Sorry, I think that also explains the trend, in buffer protect ETF in the US as well, which is using a lot of options-based strategy to provide income strategies and with downside protection. So I'm just going to move on to Bertrand. So since we're talking volatility and hedging, so what are your views of, from a retail perspective, what are the more accessible instruments for retail to hedge their exposures?
I'm not sure if they have access to options, but from my end, without direct access to options and stuff like that, I would be more defensive. From a Singapore perspective, we are a AAA country, so I'd be biased towards Singapore dollars, Singapore dollar cash, Singapore dollar bonds, or any other instruments that are not exposed to the US dollar weakening trend. There's been, the US dollar weakness has been going on this year because of concerns on instability of policy, concerns on Fed independence, and concern on the outlook on policy rates. And so we've seen reallocation into the local currencies in the region. So I think that's a natural hedge and also a hedging from that perspective. Not a full direct hedge of your US equity exposure like options can do, but it's more risk diversification or lowering down the risk profile of your portfolio.
Jira, what are your thoughts? What do you, beyond, Singapore dollar bonds or T-bills, do you have any, what do you think would be accessible products for retail to hedge their risk exposures?
Yeah, I think for the retail, today they have access to the risk management tool quite easily, which is provided by, online platforms or brokers. But my firm belief is can go something very simple and very simplistic. There are so many options out there that you can look out. But first of all, you have to assess what you have in your portfolio. And the true meaning of diversification is to have something that moving in different direction when something unexpected happens. So in that case, you probably take a look at, for example, apart from just equity and fixed income, is there any other asset class that you can look at, like alternative such as gold, like what I mentioned before. And, in our research, we actually have done the stress testing over the period of time. And basically that goes to show that during the global financial crisis in the past 20 years, gold has outperformed, right, the other two asset classes, equity and fixed income, between 4 to 30%. That can be the hedge and the good protection on the downside as well. Or if we are looking at the broad exposure, the high quality assets, again, we can look at the broad equity index such as S&P 500. Some people may think that, oh, I do not want to have the pure US exposure, but basically if you're trying to have the granular details about revenue of the S&P 500, you will see that 50% or less revenue is generating outside of the US or the rest of the world. So essentially you have the exposure to the quality of the stocks that is listed in the US. However, they have the operating expenses, P&L from elsewhere. And recently we also see the rally of tech stocks as well. So, these index consists of 33% of the tech sector. You can enjoy or get the upside participation on that. But at the same time, if you have the decent proportion of diversification in this case, it will help to protect as a hedging tool.
Great. So we have provided some options for hedging and what would be very accessible. So let me turn to Keith so that he could share his thoughts on how investors can evaluate the cost effectiveness of hedging strategies.
Sure. When we use instruments to hedge, especially leverage inverse products, a lot of investors, when they hear the word leverage, they say this is risky. Yes, of course it's risky because it's leverage, right? But how you can manage this risk and cost is actually based on how much capital that you would use to put in these instruments among your whole portfolio, right? For example, if you want to get an exposure of NVIDIA using the leverage products, to get the same exposure as an underlying, let's say you're planning to spend, let's say $10,000 on an NVIDIA with a 5x leverage products. So if you're using a capital of $2,000, you're actually getting the same exposure as a $10,000 capital on the stock, right? So using less capital, using the leverage exposure to give you more capital efficiency, so free up capital that you can diversify, you can go into other asset class to diversify a portfolio, kind of ways that you can manage your position more cost effectively. And also the other thing is hedging as well, right? So if you always have to think about your own shares, your portfolio, and how you can use this instrument to protect any downside risk. So when all the U.S. stocks are reaching record levels, you are thinking, okay, should I sell my stock to take profit? But the trend is still on the upside. So or should I use some of the capital to buy an inverse 3x short DLCs, for example, on the SGX, that you can hedge a bit of that downside risk of the stocks, right? So these are some of the ways that you can maybe use leverage inverse instrument to improve your efficiency of capital when you manage your portfolio.
Thank you. I think I alluded a little bit to Buffer Protect ETF earlier, which is very much based on options-based strategies. So I'm going to turn my attention back to Christian and ask him, what role do structured products or options-based strategies play in building a more resilient portfolio?
I would say a few different ways to think about that. First of all, it depends on what the product is trying to achieve. And just as an example, we manage basically two different types of strategies. One, which is called equity premium income. The focus is income as an outcome for clients. So this is a strategy which tends to be more defensive because there is much more focus on income generation. in the context of total return. And therefore, you think about like the application into income modules, for example, as well as a more conservative equity exposure, because your beta to the market is lower than 1. And you have this constant income like generation over time. So that's one type. The second one is a hedged equity type of strategy, which is combining an active equity portfolio with an option overlay to systematically hedge on the downside if the S&P goes down more than 5%, all the way to 20%. And that's very much what I would think about of a conservative equity type of solution. For those like investors which are worried about the S&P being at all-time high, maybe you want to see a correction going forward. Instead of trying to time the market to get entirely out of the market, this is a type of solution which enables them to dial down the risk profile of their allocation in equities, but still be invested in the market at the same time. So for me, it's really about income module type of exposure, income generation, and the other one being more conservative equity, which allow you to be in the market and not be completely out.
Yes, couldn't agree more. I'm just very mindful of time. We have 5 minutes left, and I do have 16 questions here, so we do want to take the opportunity to perhaps try to address some of these questions. But before we go ahead and do that, I think it says on my notes some actionable items. So we do want to leave you with some of that. So the question which I would ask all the panelists to give like a one-sentence answer is, if you had to recommend one smart move to help investors prepare for volatility or market turbulence, what would it be? Bertrand? Please start first. We'll go this way now.
Personally, it's more staying disciplined and keep diversification.
Keep US, keep Sing dollars.
No, more like being disciplined and keep diversified.
Thank you. And Christian?
Yeah, I would say don't overreact. I think what we've seen earlier this year, the S&P drawdown, and the recovery, if you overreact at that point in time, you're probably going to make the wrong decision. So it's more about like how do you build balance in your allocations, and that's where there are products, strategy which can help to build that balance.
Yeah, I think for me, we should focus both short-term and the long-term, but especially on the long-term, right? We should set up the portfolio that works for you, even if you are not watching it. So think about the asset classes that, or the assets that can give you that power.
Yes, so for me, I think, upcoming months, there's going to be a lot of volatility in the market. And a lot of times could be event-driven, right? So one tip I would say is encourage you to, after you wake up in the Asian hours, first thing you do is look at what happened last night, what did Trump say, and then go to a website. You can actually see US stock prices already reflecting the news during Asian hours, all right? So for those of you who are holding NVIDIA and Tesla, there's opportunities where you can trade these US stock via instruments during the Asian hours to be ahead of the US market open, right? So there are new opportunities there that you can get more visibility ahead of US open during Asian hours.
Yes, indeed. Some index options trade close to 20 hours too. Just kidding. Okay, so I'm just going to the questions. And I think one question is quite interesting, right? So we also mentioned, we touched upon it. So it was asking like, why do you think markets or investors don't care much about what's happening in the US with all the tariffs compared, and compared to the impact of Liberation Day? Or why is the market just not factoring some of those impacts? I see Bertrand.
Isn't there a market term for it? Like they call it taco? Trump always chickens out. So I think people think that he will just go back, de-escalate everything, and the market calls it a taco trade.
Maybe I can add to that. Maybe a lot of us are surprised by the all-time high of S&P 500. And recently I came across the article and research done by S&P, but basically because of the tariff tension, a lot of businesses in the US are very skeptical and scared of, making a new development or research or trying to do expansion. So end up they do a lot of buyback stocks, and that's the reason why it's actually helped to support the equity market. So that could be one of the factors, the reason why equity is still doing pretty well because of that.
Okay, thank you. Okay, less than 1 minute left. I'll take another question because we touched on it as well. So the question is commodities like gold always, so the word here is always, the most resilient asset to include in one's portfolio? Who would take a step at this?
Yes, I
Ganjira?
can take that. Absolutely. In our house view, based on the 60-40 allocation, once again, we believe that gold should be allocated around 5 to 10%. To reduce the maximum drawdown. And again, you also can, it helps to protect or preserve the wealth as well. So I think that's the balance that you should think about. And then, but sometimes people ask like, how about beyond 10%? Would that help? It really depends on how you construct your portfolio, but that's the ideal.
Perfect. What a notable end to this panel. Thank you all the panelists for your valuable insights. We hope the audience enjoyed this session. And thank you to Moomoo for having us. Thank you.